Hi everyone. So welcome back to the audit chapter, and today we will be talking about the substantive procedures that we perform in the audit. So we have been discussing throughout the process that what are the audit procedures and how it is performed. So first part was the risk assessment procedures that we have already discussed. After that it was the further audit procedures. Under the further audit procedures, it includes the test of the controls that we have already discussed. Test of controls involved the performance inspection, investigation, and observations, and we have detailed discussion about this. Now, the further audit procedures also include the substantive procedures. So, what are the substantive procedures? So, substantive procedures are something that is performed to detect the material misstatement at the assertion level. It is required for each material transactions, class, account balances, and disclosure item, irrespective of the assessed RMM, even if that is low. There are two categories of the substantive transactions, that is test of details and analytical procedures. Test of details applies to the transaction classes, account balances, and disclosures, if any, whereas analytical procedures are the evaluation of the financials information through the analysis of the plausible relationship among both financial and non-financial data, encompasses the investigation of any identified fluctuation or unusual, expected, unexpected, any such type of relationship. So analytical procedure is more applicable to the large volume of the transactions, that tends to be the predictable over the time. So as we understood here, uh, what is the substantive audit procedures and how it impacts, what are the part of the further substantive audit procedures. Now, if we discuss further on this, so here is the summary of substantive procedure, like that involves test of the details and analytical procedures. So auditor substantive procedures is included test of the details and analytical procedures. So here the management assertions are the cover up that we have discussed: the completeness, observation, valuation, existence, rights and obligations, and understanding and presentation. So these were the management assertions which were tested in substantive audit procedures. Let's further dig down what's this, and let's understand that. So test of the details. First part is a test of the details that comes as a part of the substantive audit procedures. So you had been seeing in the screen the mnemonics a lot of times since the starting of the chapter. Review care it was written. So for the RIIO was same, that was in the test of the controls, re-performance, inspection, inquiry, and observation. CAR means confirmation, asset inspection, and reconciliation. And RACE means recalculation, auditing related to the account, simultaneously cut-off procedures, and events subsequent to the balance sheet. So all these application in the audit is the part of the test of the details, and when we complete this procedure, the test of details is completed. So let's understand what's reperformance. Reperformance means independently execution of the procedures or control that were originally performed by the entity personnel. Okay, so reperforming the things that management has already done to gain comfort over the data. Inquiry seek information on the financial and non-financial of the knowledgeable person, internally, externally, in written or oral. All this will be the inquiry. Inspection examine documents or records. So automated tools such as vouching or tracing, vouching for the existence, tracing for the completeness, all this comes under the inspection. Observation means looking at the process and procedures performed by others, either by physical presence or use of remote observation tools. So to observe anything in the audit is comes under the observation. Confirmation obtain direct written information from the third party about the balances, transactions, or events, terms of the agreement, especially in the AR or AP or bank. The confirmation is obtained from the third party with whom transactions has been done to gain the to understand to gain the existence and the completeness of the assertions on that balances on that transactions. Asset inspection physically examine the tangible assets like inspection of PPE, that comes under the asset inspection. Reconciliation, compare and agree of the transactions from the two sources like cash balance as per the bank books and as per the management books, and to reconcile if any differences are there. Recalculation, footing and cross footing. So here the mathematical accuracy is checked, retotaling is checked, all the footing and cross footing are verified. Auditing related to the account simultaneously. Testing revenue or expenses transaction alongside related asset and liability, like matching sales with AR or COGS with inventory, dividend income with dividend or interest with the investment. All these are tracing audit related to the account simultaneously. After that comes the cut off procedures. Here test of the transaction is done especially around year end, to validate if they are recorded in the correct accounting period or not, like sales, purchase, inventory, cash, accruals. For this, cutoff is performed. Events subsequent to the balance sheet date. Perform procedures to test the events after balance sheet date up to the date of the auditor's report, like settlement of the contingent liability after balance sheet date, to ensure that the events pertains to the which balance sheet date. So this was all about the test of the details that we have discussed. Now coming forward, is a directional testing by the inspection, that is by vouching and tracing. Vouching means examine the documents in the reverse order of the preparation to check the management assertions of the existence and occurrence, whereas tracing means examining the documents in order. So vouching is in the reverse order and tracing is in the order of the preparation of the check management assertion of the completeness. In vouching, we gain the existence assertion comfort over the existence assertions, whereas as in tracing, we get the comfort over the completeness assertions. Possible approach of the test of the details. So these are the test of the transactions and test of the account balances. Test of the details further, if we dig down into the test of the details, it will be divided into transactions and account balances. Transactions again income statement thing, account balances again balance sheet thing. So auditor test transactions during the period, especially if the few transaction or large transaction amount, investment, PPE, bond, stockholders equity. Whereas account balances are the testing the period end balances if the numerous transactions, and such as cash, AR, inventory or AP, such are the year end transactions. Talking about the nature, extent and timing of the test of the details based on RMM assessment and level of the detection risk that needs to be achieved. So nature here, auditor determines whether to perform the test of the details, analytical procedures or both. Also, the test of details are designed based on the relevant assertions. Test of the details related to the existence or occurrence assertions may involve selecting the items contained in the financial statement amount and obtaining the relevant audit evidence. Test of the details related to the completeness assertion may involve selecting the items that are expected to be included in the relevant financial statement amount and investigating whether they are included or not. Talking about the extent, ordinarily extent implies the sample size. So few method of selecting the item for testing are select all the items or specific items, or use audit sampling based on the category, based on the risk involved in that category. Timing is generally substantive test closer to the period end may be more effective than the interim testing, especially when RMM is high. It may be in the combination of the interim or the period end testing, or if auditor detects unexpected misstatement at the interim date. So timing is again the professional judgment used by the auditors, especially if it is done at the year end period. But depending upon the situations, depending upon the risk, the auditor can combine their judgment and have the timings determined. Also, the auditor may consider the cost-benefit relationship in selecting the appropriate procedures. However, difficulty, time, or cost are not a valid reason to omit an audit procedures. So this is very simple. The auditor should use professionals to determine the cost and benefit, and as a part of that, timing and cost. Timing should not be the part of the cost. That should not be part to determine the cost. Now coming to the analytical procedures. Analytical procedures are the evaluation of the financials information through the analysis of the plausible relationship among both financial and non-financial data. It encompasses investigation of the identified fluctuations or unusual, unexpected, inconsistent relationships. So it is basically identifying the variances, unexpected relationship, unexpected transactions, any fluctuations that has been observed in current year accounting reporting period. After that, so analytical procedures include consideration of like what is budgeted and actual, what's the difference between the budgeted and actual, to understand the reason for that. Relationship, ratio, trend analysis are the part of the analytical procedures. Comparison between the industry level and the entity level, what is the percentage the entity holds among the industry and how it is performing earlier periods versus this period. So comparison from the past periods to the current years, like what developments has been done, is the profit increased or decreased, what are the reason for all those, that is compared. Also financial versus non-financials, so how much data captured by the financial data and how much is by non-financial data, and what are the impact of the management defined procedures and all those things in the financial statement. So that is also captured here. May also be applied to the consolidated financial statement, and individual elements may use to disaggregate the data. Analytical procedures range from performing simple comparison to performing complex analysis using advanced statistical tools. Scanning is a type of analytical procedures involving the exercise of the auditor's professional judgment to review the accounting data to identify significant or unusual items to test. This may include identification of the unusual data to identify the significant or unusual items. Also, in general, the relationship involves income statement account tend to more predictable than the involving the balance sheet accounts. This is because income statement accounts are represent transactions over the period of the time, whereas balance sheet represents as at the point of the time. So that may be that is one of the reasons. Also, now we will talk about something else, and that's the firstly we will discuss the comparison, then we will come to the ratios. So at the planning stage, analytical procedure is mandatory, and at completion stage analytical procedure is mandatory, but at the substantive procedures it is optional to be performed. But at the planning to determine and at the completion what the conclusion has been reached out, analytical procedure is mandatory. The purpose at the planning is made identify the aspect of the entity which auditor is unaware and may assist in assessing RMM in order to provide a basis for the planning of the entity of the audit procedures. Whereas in the completion, the use of the analytical procedure is to assist the auditor when forming an overall conclusion about whether financial statements are consistent with the auditor's understanding of the entity. Also, it is generally performed by the audit partner, whereas in substantive procedures, it is optional, but if done, the purpose of the analytical procedure is to obtain the evidence on the relevant assertions for the transactions balance and reduce the detection risk. Auditor's decision whether to use test of the details only, substantive analytical procedures only, or combination of the both. So this is the purpose of the analytical procedures in the substantive period. Now let's come to the ratios. Ratios are the part of the analytical procedures. So it is commonly used while considering budget, relationship, all those things that we have understood in the analytical procedures. So there are broadly 4 ratios: liquidity ratios, activity ratios, profitability ratios, and coverage ratios. We will discuss the formulas and the purpose of these ratios. So liquidity ratios are there to measure the entity's ability to pay its maturing obligations in the short term. Under liquidity ratio comes the working capital current ratio, quick or acid test ratio, current cash debt coverage ratio. Working capital is current asset minus current liabilities, and it measures the operating liquidity of the entity. Current ratio is current assets by current liability. and it measures the entity ability to pay the short-term obligations. Quick or acid test ratio is the cash, marketable securities and receivables divided by the current liabilities, and it is used to measure the entity's ability to immediately pay its short-term obligations. Current cash debt coverage ratio is net cash provided by the operating activities divided by average current liabilities, and this is used to measure the entity's ability to pay its current liabilities from the operations. Now we come to the activity ratio, which measures the efficiency of the entity's business operations. Under the activity ratio comes the receivable turnover, inventory turnover, asset turnover, and number of days supply in the average inventory. Receivable turnover is the formula for the receivable turnover is net credit sales by the average trade receivable, and it is used to measure the entity's ability to efficiently extend the credit and collect the funds from the AR. Inventory turnover is COGS by average inventory. It is used to measure the number of times inventory is sold or used during the period. Asset turnover is net sales by the average assets, and it is used to measure entity ability to efficiently use its asset to the generate sales. Number of the days supply is again 365 by the inventory turnover, and for the sales 365 by the receivable turnover. Now coming to the profitability ratio, it is used to measure the entity's ability to generate the earnings. Under profitability ratio comes the profit margin, rate of the return on the assets, return on the equity, earnings per share, price ratio, payout ratio. Profit margin is net income by the net sales, and it measures the net income generated for each transaction of the sales. Rate of the return of the asset is the net income by the total assets. Rate on the equity is net income minus preferred dividends by average common shareholders. EPS is net income minus preferred dividend by weighted shares outstanding. Price earning ratio and payout ratio, they are there. And lastly, coverage ratio, it measures the entity ability to meet the financial obligations. Under coverage ratio comes the debt to equity, debt to total asset, time of interest earned, cash debt coverage ratio, and book value per share. All these are the ratios that we have discussed, and this comes under the analytical procedures of a substantive procedures, which are the further audit procedures. So that's all about substantive procedures. I will see you in the next chapter of audit. Let me know if you have any questions in the comment section, and I will help you to resolve those out. Bye bye.